Here. So welcome everybody and good morning. Thank you for joining us at Gravita for our live webinar on business tax and refresher and planning seminar presented by our good friend Tim Palmer, who will be taking you through a number of different opportunities and ideas, looking at latest tax news and developments for businesses, that horrible basis period reform and where are we now on that. Some corporation tax planning ideas and some bits particularly on capital allowances because they are a very useful tool for reducing your tax exposure. And then looking at family investment companies a little bit, and just to add that we will be releasing an infographic on, which is like a storyboard, right? You can see through YouTube on family investment companies at some point in the not too distant future. So please keep your eyes out for that. And then Tim will go on to the bit that I always find most interesting, which is the recent tax cases and looking at what has been going through the court process as it stands today. The only other thing before I let Tim get going is on the 30th of October, our Chancellor will be delivering Labour's first budget for the last 14 years. It is sure to be interesting, to say the least.
I'd use the word
blockbuster. It certainly won't be one that will be ignored. It will be one of these which has a lot of changes and a lot of comment will fall from it. And we will, of course, make our voices known as part of that debate and let you all know how we see it and what changes might affect your clients as well as our own, and help you through it as much as we can. That all said, over to you, Tim.
Thank you very much, Tom. Great to see you again. Right, okay. Good morning, everyone. Welcome to this business tax refresher and planning webinar on behalf of Gravita. I'm Tim Palmer. I lecture all over the UK and I'm a tax consultant with Gravita. I'm a slightly tanned Tim Palmer. I don't know if you can see that through the screen, but I've just literally come back from Rhodes in Greece, where we had a lovely holiday. It was one of the best holidays I've ever had, actually. It was fantastic. Fantastic time there. Not much more I can say, except, as I told Tom a few minutes ago, when I was on my sunbed in Greece, it's just amazing. Barb and I, my wife and I, are resting on our sunbeds, and this was about 11 o'clock, and this man comes over and taps me on my arm, and he said to me, "Excuse me, you're Tim Palmer, aren't you?" I thought, yes. I said, yes. And he said, "I've been coming to your lectures for years. It's great to see you." So as I was on my sunbed in Rhodes, a man came up to me. Barb will give you more information on this if you ever speak to her. And we actually had a long chat subsequently in the afternoon at the bar about football and lots of things. But my only regret was that I didn't have a business card or my business cards with me on that holiday. Perhaps that's not a regret because it's great to get away from it all. But seriously, had a great time. Right, now, the business tax refresher this morning. You do need a set of notes in front of you, okay? You really do need them, and Justine's great on our Gravita team. And you want a set of notes in front of you. If you haven't got them, can I suggest that you just make a last-minute download or get hold of them? Because I put a lot of effort into these notes. In today's notes, how many pages? I think it's quite a few. 20 for 1 hour. We finish at 10 o'clock, 20 pages. And so you want the notes in front of you and mark them up with my extra comments, because I'm not going to hold back today. I'm going to give you my opinion on everything. And we're going to finish fairly promptly at 10 o'clock. But you want the notes in front of you to mark them up with my extra comments. Right, okay. If you've got any queries today, or you need any tax consultancy, which you might do, and you want to reach out to us, perhaps the best thing is for you to reach out to Tom, and Tom or one of his team will help you. You might want to jot down from the screen Tom's email address there, but you can reach out to us and we'd be delighted to help you, because these are very interesting. Can I use the word dangerous? Perhaps that's the wrong word. But these times, I mean, it fascinates me, it really does. Ever since I've come back from holiday, I've been on the internet seeing what people are saying. I've done a few, can you believe, webinars and lectures this week. Yesterday, I was doing a webinar nationally, and I had an email from somebody in New Zealand who was watching it in New Zealand, which was incredible. So these are changing times, but these are big times for tax. And as Tom said, capital allowances are all over the internet at the moment. Right, if you really do need my notes, go to page 2, and you want to mark up the notes and jot down the things that I'm saying. But there is huge speculation, and that, you know, just before I left on holiday, I was doing another national live lecture, and I spoke to another lecturer at the break, and he said, have you seen the internet? Have you heard the rumours that the Labour government is going to restrict and cap company capital allowances? And I said, yes, I have. That is a really ongoing rumour at the moment. So you want to mark up my notes, because I'm not going to hold back. I'm going to tell you all the things that that I'm hearing, that I'm experiencing, that I'm worried about. And so at the moment, if you've got a company, they can claim 100% capital allowances. It's known as company expensing, 100% first year allowances. And they claim this expensing. And if anything, if I was to be really honest, it's too generous, because there's no cap at all, which staggers me, actually. I'm really surprised about that. And that's what I think possibly the Labour government could announce on Budget Day, 30th of October. Now, in the 1980s, I was very lucky, actually. Just before my dad died, he knew the chairman of a big group on the stock exchange. And I went to work for them in their tax department. It was a shipping group. And the one thing it changed my tax career on was capital allowances, because they had ships and we got 100%. They used to call it free depreciation on ships. And it created huge losses because it was uncapped. And you group believe the losses. And that was in the 1980s. And we've come full circle, really, to that again. Because I did a lecture before my holiday to huge companies in industry. I was asked to do it. I was honoured to do it. And they told me everything. There was a lot of dialogue. And they said, we can't believe that we get 100% capital allowances on plant and machinery, uncapped. And to what they were basically saying was that it created huge losses for them. They group really the losses. This is like me going back to the 80s, you know, in full circle, really. And if you look at my notes on page 2, this page 2 is just a refresher on the current capital allowances regime for companies, and it's incredibly generous. You get this company expensing that's uncapped, but you have to buy brand new. You have to spend money on brand new plant and machinery. Individuals and partnerships don't get the company expensing, obviously, but they do get the annual investment allowance that gives them 100% capital allowances up to $1 million. And that's probably more efficient because it's on brand new and second-hand plant and machinery. Companies also get that as well. So I haven't had too many instances where individuals have problems with their capital allowances because they get the annual investment allowance. But going back to companies, they get these 100% capital allowances on brand new plant and machinery, unused and uncapped. You know, it's incredible, very generous capital allowances. And I do worry that the Labour government on their 30th of October budget, which is all quite heavily over the internet at the moment, the rumours are that they're going to introduce a cap on the capital allowances, which you could understand them doing. So it'll be very interesting. The only thing I would say is that if you sell this plant on which you've got the company expensing, you get an immediate balancing charge, and you can't put the proceeds in the general plant pool. I mean, you look at the Harris example on page 2 of your notes. They might have spent some money on second-hand plant. They buy $1 million of plant. They get 100% capital allowances, company expensing on the $1 million. And then 2 years later, in 2026, they sell it for 600,000. You will get an immediate balancing charge on that 600,000, and you can't shelter the 600,000 pounds by putting it in the general plant pool. So you got to be a bit careful with the balancing charge position. And a lot of these majority of all of these companies will have a deferred tax liability because they've claimed all their capital allowances. When I was in industry working in the 1980s, that cemented my interest in deferred tax because we had to fully provide for it, and I've done lectures on it since. This is me being really boring here, but I'm into deferred tax. Can you believe that? Can you believe somebody said that? I have. But you do have to provide for it. And obviously these companies will have deferred tax liabilities. Now, so you're aware that companies now get this 100% uncapped cap allowances on brand new plant and machinery, but will it all be capped and announced on the 30th of October? If so, if they do that, which I suspect they will, when will that come in? Will it be immediate, the cap, or will it take effect from the new financial year for companies for 1st of April 2025? I don't know. Be interesting to see. So the bigger companies are currently delighted with everything, and the cap allowances that they've been claiming after speaking to them have creating huge tax losses, which they group relieve, they carry forward. And remember, when a company carries forward a tax loss, they can carry the tax loss forward against anything at all, a company. You know, investment income, trading profits if they become profitable again, capital gains up to 5 million and 50% of the profits above 5 million, and income gains above 5 million. So this is currently a very generous regime, but I do fear that it's going to be curtailed very shortly. Perhaps you need to do some planning beforehand. Now, if you go over to page 3 of the notes, there's been a really, really interesting cap allowances recent case, Acorn Venture Limited. If you could pick out a cap allowances case that's so useful to me, you know, as an advisor on cap allowances, as a lecturer, this would be the one. And it's superb. Is it plant? Now, you have to be careful when you do cap allowances. And I always say to clients, big clients who are going to create a new restaurant, a new hotel, you need to speak to me before you plan the expenditure. I need to speak with the architect. I need to speak with everyone, because if you do the planning and the expenditure and you conduct your business in a way that I want you to do, I can get you your maximum cap allowances. And in this case, Acorn Ventures, I mean, I think what I might do is ad-lib it because it's on pages 3 and 4, but I'm so familiar with it that I can just cut to the chase and just ad-lib and tell you what happened. Acorn Venture Limited, this is an incredible case, really. So they provided adventure holidays for school children, and they spent money, if you look at your notes on page 3, on 26 pods. All right. 20 of the pods were very basic, designed for the children to sleep in, and they weren't fixed to anything, and they could be moved, and they certainly weren't buildings. But the other 6 were teacher pods, which were much more sophisticated. They had plumbing, they were fixed to the ground so the water could go through. And as soon as I saw this case, I thought, I think the 20 will qualify for plant, the basic pods, which the kids lived in, which were not fixed. But I thought, you're going to have a problem with these other 6, the teacher pods, because these are fixed. You know, the plumbing's there, the water's there, everything's there. So they spent the money on the 26 pods. 20 were basic pods, not fixed, and they were not buildings. So they did qualify as plant. But the other 6, I think, really were buildings, and the teacher pods fixed, and they were buildings, so they didn't qualify as plant. Right, now if you go to page 3 in the middle, let's have a look at these basic pods. They weren't fixed. They were a bit like upturned boats. Can you see that on page 3? They lacked sufficient substance to be termed as buildings. They weren't fixed to the ground. So 20 of these pods, the basic pods, qualified as plant. And I think there was no doubt about that. And so they weren't buildings. Now, you have to be very careful when you do cap allowances claims in this type of area, and you have to use the legislation. Now, I've put the legislation on page 5 of your notes But if you go to page 5, section 21 of the Capital Allowances Act says that if the expenditure is a building, obviously it won't qualify as plant and machinery. And also, if you go to the next section on page 5, just turn over the notes a few pages. Section 22 says if it's a structure, it won't qualify as plant either. But you have to be careful because you have to look at the legislation. Go over to page 6. And what's a structure? A structure means a fixed structure of any kind. Right, okay, so if I go back to page 3, can you do that with me as well? These basic pods were structures, but they weren't fixed structures, so they qualified as plant. Right, now the teacher pods, if we go to page 3 there, the teacher pods, these were fixed, and they were completely different. They had flushing toilets, they had washing facilities, they were plumbed in. There was a degree of permanence. And as soon as I read that, I thought they're structures, they're fixed structures. They're effectively, they won't qualify as plant, and they didn't. But then when it went to court, the judge had a decision to make. And the decision that he had to make was, are they buildings as well? And they were buildings. So I'm going to ask you to look at the legislation again. And if you look on page 6 of your notes, section 23, hold on, I'll go back there, says these section that prevents you claiming plant and machinery capital allowances don't apply to any expenditure within list C. So if you go to list C, which is on page 7, there's 33 items there. And at the very bottom of page 7, you've got item 21. Can you see it on the bottom of your screen? Movable buildings intended to be moved in the course of the qualifying activity. Right. So these teacher pods, which were fixed, the judge said they are buildings, but there's a get out clause, section 21 of list C. And if they're movable buildings intended to be moved in the course of the trade, then they can qualify as plant. Right, so did these teacher pods move? Can we go back to page 4? Did they move? They were delivered to the site in forklift trucks, but the director, when he was in court, he had to make a honest statement, and he said they could be moved. 1 man, 4 men, 1 man in each corner of the pod could lift them up and move them. So they were movable buildings. But the judge then asked him, did you intend to move these buildings in the periods that we're looking at? And he had to be honest, and he said, no, we had no intentions of moving them. That was the big mistake. And therefore, they didn't qualify for the capital allowances as movable buildings intended to be moved in the course of the trade. Now, if I'd have been speaking to them before they'd have started all of this, I'd have said, I think your basic pods qualify, they're not buildings, they're movable, they're not fixed, there's no problem with them. I think your teacher pods are fixed, I think they're fixed structures, and in fact, I think they're buildings, but you can move them. Now, you've got a big area of land here. Surely, if you move these teachers' pods, this is the planning on page 4, if you move these teachers' pods, you could attract repeat teachers and repeat schools coming back because they'd have a different part of the site to go to. Surely it would be in your interest to move them. I would recommend you do move them. I would recommend that you film that you're moving them. I would recommend that you document that you intend to move them so that the teachers, when they have a repeat visit, can come to a different area of the site, different trees, different everything around them, and you'd encourage repeat business. I put this all within my planning notes on page 4. So I think, it all depends on what they wanted and everything like that. But I think if they'd have had a planning meeting with, capital allowances specialists, and I'm not saying they didn't, but, I don't know all the facts here, but I think there would have been a possibility, a strong possibility of those teacher pods even though they were buildings, there's an exemption for movable buildings intended to be moved in the course of the trade. If they had intended to move them, and they did move them to another part of the site of the camping area to get repeat business, they would have done two things: increase their turnover and for movable buildings intended to be moved in the course of the trade. So what I'm trying, it's difficult sometimes as a lecturer to bring all these points over, but what I'm trying to say is that I think these types of people who incur big capital expenditure, I mean, if you look at the previous page, the judge disallowed, how much of it? Was it 386,000, something like that? So they had a big battle on their hands. All of this perhaps could have been avoided. I only hope they had fee protection insurance, because I've seen in a couple of cases where a small business has paid a small fee protection premium. The revenue have disallowed something that was wrong by HMRC, and the fee protection company has agreed to pay the fees of the barristers of 100,000 to go to the lower tier tribunal. I hope they had fee protection, and I hope their barristers' fees were paid and covered by the fee protection insurance. I don't know, the case didn't state that. So, you know, I know people have different views on fee protection, but I'm quite a big advocate, having had a lot of experience in fee protection over the years. And I think it's an essential thing, but you obviously can't claim the deduction for the premium. Right, so cap allowances, I think the conclusion from that is companies must liaise, and all businesses really, with their advisors well before they start to plan, start to incur their expenditure, so that you can get the maximum cap allowances. And we at Gravita, we do have a very experienced cap allowances team. Tom and all the others can help you in this area if you need advice. And I think this is a very topical time for cap allowances, as I mentioned at the start. Perhaps you do need to consider the position now. Have a look at the legislation. It's on page 5 of the notes, okay? And can I just repeat what I said? If it's a building, it won't qualify as plant. If it's a structure, section 22, bottom page 5, will prevent cap allowances as well. But remember, it's got to be a fixed structure to deny the cap allowances. That point is there on page 6 in the middle. A structure means a fixed structure. Can you see that there? And then the get out of jail clause is section 23, and all these 33 things that are on page 7 and page 8, any of these 33 things are unaffected by the disallowance of cap allowances. So if you go down that list, we've done some big claims in the past on number 7, sound insulation. Do you remember there was a group called the Rizzle Kicks? You won't probably remember them, but they're a big hit. And my daughter years ago took me to their concert, was Love That Sound by the Rizzle Kicks, but you won't have heard of them. But sound insulation, yeah, we've had some huge cap allowances claims. All these items on these 33, movable partitioning, decorative assets, burglar alarm systems, they qualify as plant. Swimming pools, we did a big claim for a hotel that put in a leisure centre. We had a lot of joy with that. The revenue queried a lot of things, but we won 100% with all our cap allowances claims. And there's the one, perhaps with a bit of planning, that Acorn could have claimed: movable buildings intended to be moved in the course of the trade. Right, leave you to look at all of that. Now, can I just remind you, if you go on to page 9, that the furnished holiday lettings legislation, the tax, very generous tax regime, is being scrapped on the 6th of April 2025. This is page 9. This is just a 3-minute reminder. We actually at Gravita, we got a webinar on this on the 30th of October. More on that in a moment. But at my lectures and webinars recently, I've had a lot of questions and some work from other accountants saying we act for a lot of people who've got furnished holiday lettings. And the furnished holiday lettings tax regime is being scrapped from 6th of April 2025. they've had it very good with their tax. Their position was effectively that they've been treated as a trade, as a business. So they've had capital allowances claims, pension contributions relief, entrepreneurs relief, now called business asset disposal relief, rollover relief claims, everything. And that all comes to an end. Now, I would imagine that there's hundreds of people watching this today, and I would imagine there's a lot of accountants out there who act for furnished RD lettings properties. My mum, when she was alive, she died earlier this year, but my mum was from Exeter, and we spent a lot of our school holidays in Devon every year, Dawlish, and through her, later in life, I picked up clients. And I always remember acting for one guy in Dawlish, Warren, lovely part of the world. And he owned a cottage that he rented out, and it was furnished RD lettings in Dawlish in Devon. And when he did up the cottage, he got cap allowances. He made a big profit on the renting, and he paid pension contributions against that profit. It so encouraged him that he got other properties down in Bournemouth, or should I say up in Bournemouth compared to him, also Cornwall. He was rolling over gains. He was selling properties and getting entrepreneurs relief, paying 10%. His tax regime was fantastic. But all of this comes to an end on the 6th of April. And the one thing a couple of things I would say, but we're going to go through it more in our webinar on the 30th of October. The cap allowances regime ceases for them from 6th of April. And so a lot of landlords now who've got furnished RD lettings properties are reviewing their cap allowances position for the last time, because for new expenditure from 6th of April 2025, they won't qualify for cap allowances anymore. Now, I was very worried when they announced this. Will they have a deemed cessation? That's what went through my mind. And will we have balancing charges? Well, the good news is that they're not going to have that. So there's no balancing charges. And surprisingly, but this is very generous, I think, and it's good news, if you are a furnished RD lettings landlord and you've got a pool, general plant pool, say, which you probably will have, you can carry that pool forward beyond the 6th of April and get writing down allowances after 6th of April. So that's really good, very, very good. And there's no deemed cessation, no balancing charge, if you like, for cap allowances purposes. But the thing you do need to plan for is that for new expenditure from 6th of April, there's no more cap allowances. Instead, what you've got, your furnished RD lettings business will revert and become like a normal property business, and you only get relief when you replace the existing furniture and that sort of thing. So that it's not going to be so generous at all. So we've had a few clients contact us and other accountants, and they've said to us, we think that some of our clients who've got a big furnished RD lettings property portfolio need to incur capital allowances in the window of opportunity, which is now to the 5th of April 2025, and they do. And the other things they need to think about are pension contributions between now and 5th of April 2025, because after 6th of April, furnished RD lettings profits will not be relevant earnings, and you can't get tax relief from 6th of April 25 if you're a furnished RD lettings owner for your pension contributions anymore. So we've had a lot of clients contact us and say, should we make greater pension contributions, get relief for it for the last time in this tax year? We will address all of that when we have our webinar on the 30th landlords generally. So that's a note for your diary. I did say at the start, you're going to note down extra things today. That's a note for your diary. And I think it's a very topical time to have that on Wednesday morning, 30th of October. If you're not signed up for that, perhaps you need to be, and you want to get signed up for that shortly. Right, let's move on, getting behind, so much to cover today. This should be a 5-hour webinar. Anyway, go to page 10. Now, a very hot topic at the moment, And I don't know if HMRC, do their head boffins sit down and plan the things they're going to attack, plan the things they're going to look into. But we've had, and there has been, a lot of tax cases recently. Are you trading? And when did you start to trade? I could pick out quite a few. There's been a big case on this. And the big case, which I've gone through and really summarized on page 10 and 11 of your notes, was Mr. Wardle, J. Wardle versus HMRC, a very recent case as well. And what happened in this case was that this guy had, it was quite a big limited liability partnership. And he had 14.65% of that, and it was worth a lot of money. Right, page 10. And this LLP was set up as a special purpose vehicle to construct and operate a power plant in Hull using wood waste biomasses as its fuel. Now, I'm not going to go into all the technicalities because it's in your notes and you could read the pages after the webinar. But in a nutshell, what happened was that in February 2020, Mr. Wardle sold his share in the partnership, of his share of the partnership. He's made a big capital gain in February 2020. He timed it really well, didn't he? Because in March 2020, when Rishi Sunak had his first budget as Chancellor, he overnight changed Entrepreneurs Relief into Business Asset Disposal Relief, and he reduced the lifetime limit from 10 million to 1 million. So Mr. Wardle timed his sale perfectly in February 2020, and he sold his share of the LLP, and he claimed Entrepreneurs Relief, February 2020. And so he said that the gain should be charged at 10% CGT. The big issue was that HMRC said you can't get Entrepreneurs Relief on the sale of your share of the LLP because that LLP hadn't been trading for the 2 years prior to your disposal. And Mr. Wardle said, you're wrong, it has been trading. That was the battle in this case. So this case, the aspect behind it, and it's worth reading, and I've summarized it, I think, very well on page 10 and 11. He sells his share in the LLP, he claims Entrepreneurs Relief, but the revenues say it's not a trading LLP, and therefore you can't get Entrepreneurs Relief. They had huge correspondence, they had meetings, but HMRC wouldn't budge. So he goes to the first tier tribunal, right? And he represents himself, which was surprising, but he was very good. And he'd done his research and he said, the LLP has been trading for the 2 years prior to me selling my share of the LLP. And what he did, I mean, this is incredible. He must have been advised by accountants. He quoted a case that I'm very familiar with, the Mansell case. Do you remember the racing driver Mansell? This was nothing to do with him, but every time I see Mansell, I think of that guy. If you look on page 10, the Mansell case, which the judge approved, gives you 3 steps to consider when you start to trade. And if we go through those 3 steps, the first one on the bottom of page 10, before a trade can be said to have started, there must be a specific concept of the type of trading activity which is going to be carried on. Well, there was in his case, so he passed that one. Number 2, turn over to page 11. A trade cannot start until it has been set up. Well, it had been set up, and they put everything in place, the management structure. There's no question about that. So quite easily, they knew the type of trade they were going to do. It had been set up. So what's the third stage? Has the business started to trade? You with me on the top of page 11? Well, in this case, it's very interesting. It's not necessary that a sale has been made or a service has been supplied in order for the trade to commence. Once the business has been set up, the commencement of operational activities marks the commencement of trading. You want to underline that. That is probably one of the most important things that I'm going to say this morning. I'll say it again. The third step So we've got the concept, it has been set up. The third step, has the business started to trade? It's not necessary that you've made a sale, that you've made a service in order for the trade to commence. Once the business has been set up, the commencement of operational activities marks the commencement of trading. That is so important. Now, the commencement of operational activities will include entering into contracts, dealing with third parties, acquiring goods to sell, hiring and training of staff. So the commencement of operational activities marks the commencement of trading. And all of that had happened. The commencement of operational activities had been set up, had been carried out and started by the LLP. So they had traded for the 2 years prior to the sale of his share of the LLP, and he got entrepreneur's relief. This is a huge case. If you Google this case, I mean, this case is useful for people, accountants advising when does the business start to trade. When you do these brief 150-minute webinars, as we do regularly for Gravita, we try and help people. We give advice about extra things that you need to do going away from the webinars. And if I think, I know there's a couple of people watching today that have contacted me in the last couple of weeks because they've got a battle with HMRC. Has the company started to trade? Has the business started to trade? You want to look at the Wardle case and you want to go on the internet and get articles about it. Just key in. I mean, I'll never forget, earlier this year, I'm doing an in-house tax update webinar. And I included the construction industry as well as their request to this firm of accountants. And at the tea break, this young guy comes up to me and he said, Mr. Palmer, I do have queries about some of the things you're saying today. And he said, but I won't need to trouble you because I'll go on the internet and if I search hard enough, I'll find the answers. And to a certain extent, that's true. So, you want to have a look about the date the client started to trade, the Wardle case. Are they trading? That will help you. Okay. And I have seen a letter that an accountant showed me, perhaps he shouldn't, but he showed me, and HMRC have started to quote the Wardle case with social media influencers. Can you see it in your notes on page 11? This is going the other way, and trying to prove that social media influencers started to trade at an earlier date. So it's very interesting, all of this. As Tom said in the intro, I'm mentioning recent cases this morning, and there's been another one, Mr. Stolkin, and they liquidated a company and they claimed entrepreneur's relief, but this company had not been trading. And it was pretty obvious. If they'd have given me all the facts, I'd have read it and said, well, you won't get entrepreneur's relief because you've liquidated a company that's not been trading. And they failed to get entrepreneur's relief. So if you're interested, you could have a look at that case where they failed to get it. But I always say to clients, if you are liquidating a company and you get capital distributions and you claim entrepreneur's relief, now called business asset disposal relief, you've got to be very, very careful because you got the money out cheap. The tax is relatively cheap, 10%. And then you do have to think, I've got to be careful here because if I start the same trade up again within 2 years, the revenue could apply the TAR, the Targeted Anti-Avoidance Rule, which I've given you quite a bit of background information on pages 12, 13 and 14. Do you know, a lot of accountants don't warn their clients when they liquidate a company about the TAR. So you want to jot this down. If you have a client that liquidates their company, you must warn them that if they start the same trade or a similar trade up again within 2 years from the date of the last liquidation distribution payment, and the revenue can prove that they liquidated to get the money out to avoid income tax or reduce the charge to income tax, which the revenue will always assume they did, you'll be hit by the TAR. And if you go to page 12, the impact of the TAR is that the revenue will go back to the liquidation and re-tax the distributions as income at 39.75% rather than capital gains at 10, 4 times the tax liability. Have we had people caught by the tar? Yes, we have. We've done some consultancy work on it. It's increasing now. The revenue are increasing their attacks on the tar. So can I just give you 2 minutes just to remind you about this? Please remember that if a client liquidates their company and then starts the same trade up again within 2 years, or a similar trade, within 2 years from the date of the last liquidation distribution payment, and the revenue can prove that he liquidated to avoid income tax or reduce their income tax bill, which the revenue will always assume you did, you'll be hit by the tar, and the revenue will go back and retax the capital distributions as income. Now, I've set it all out in the notes, but can I just remind you that the revenue to succeed with the tar, and we've had a few battles, and one accountant has got an ongoing tar investigation that I'm quite well aware of. The revenue have to prove that 4 conditions apply: A, B, C, and D. A, I'm going to really generally summarize this. He's got 5% of the shares of the company being liquidated. B, it was a close company. C, you've liquidated and then you've started the same trade up again in one of 5 ways. So you could liquidate and start the same trade up again as a sole trader, partnership company, LLP, or employee of a connected person. That's fact, really. And then D, it's reasonable to assume that the main purpose, or one of the main purposes of liquidating, was to avoid or reduce the charge to income tax. Now, in my experience on the tar in the last few years, the revenue will always assume that, and they'll say, prove to the contrary. So if you look at the screen, you want to jot this down, you need a commercial or exceptional reason why the company was liquidated. We had a case once, a few years ago now, where there was one. If you look at the screen, this is just a little extra, but you might want to jot it down. There was a husband and wife who owned a florist's business that they ran through a company. And the wife got cancer and it was terminal. And the husband liquidated the company, closed the business down to become a full-time carer. Tragically, she died. And then he couldn't cope with it all, which is understandable. If anything happened to Barton, I think I would stop my lecturing. I don't think I'd be able to cope with it all. But to get his mind off the grief, he did start up as a florist again. He just did it. Didn't consult with his accountants, and he did it as a sole trader. And the revenue came down on him and applied the tar. He then had to get specialist advice, which he did get, and he appealed and he said, the reason I liquidated the company was not to avoid income tax. It was to close the business down because I became my wife's full-time carer. And I've only started up again to relieve me from the grief of her dying. And the revenue considered the whole position, and they scrapped and vacated the tar assessments. So you do need, can I put that previous slide, you need a commercial reason why you liquidated or an exceptional reason like that to avoid the tar. So what I'm trying to say, and you want to make a note about this, is that if you liquidate, you've got to be very careful. If you start the same trade up again within 2 years, the tar could bite. If you've got any further queries on that, or you need any advice on that, Tom and his team would be delighted to help you. You know, we can give advice, but you need to consider the position before, in an ideal world, you start trading again. Right, talking of trading, I've never known anything like it. Every time I do a CIS lecture at the moment, and I go all over the country lecturing on CIS live now. I think my live lectures have started quite a bit more. It's settled down again following COVID. And people come up to me at the construction industry lectures and they say, are you aware that HMRC are attacking builders? And I said, in what aspect? And they said, well, the builder's got this building business, but he buys a house that's really run down, moves his wife and kids into it, does it up, gets planning permission, sells it, makes a £200,000 capital gain. But the gain is exempt because it's main residence relief. And then the builder thinks, well, that was easy. I'll do it again. And he does it again and again. And the revenue will attack him and say that he's trading in property. This is on page 15 of your notes. And the revenue quote the badges of trade, particularly that one. Existence of a similar trading transactions or interests. I've seen the revenue quote was on the screen now. Transactions that are similar to or to those of an existing trade may themselves be trading. So the builder, he's got an existing building trade. He buys a home, does it up, planning permission, sells it. The revenue will apply or try to apply that badge of trade. They'll argue, if he's done it again and again, that he's trading in property. And there's been cases on this. Tom mentioned I will quote cases today, and I am. The most recent case on this was, well, those are two older ones, Hashmi and Campbell. It's all started recently. But Gary Ives was the big recent case on this, where the builder had a building business, and then he buys a property, the Ringmer property, page 15. It was two flats, actually. Knocks it into one, makes a capital gain of $1 million, and then once he's done that, he moves on to the next one, and then the next one, all on page 15. I could see why the revenue argued that he was trading in property, and I must admit, when I read that case for the first time, I thought that he was trading in property. I agree with the revenue. Amazingly, the judge, when it went to the lower tier tribunal, came to the decision that he wasn't trading in property, and that he had lived in the properties, and that he got main residence relief, and the millions of gains that he made, there was no tax payable at all. I've been trying to find out if the revenue have appealed against the Gary Ives case. I'm sure they have, but I haven't been able to find that out yet. If they do appeal, it'll be interesting to see the outcome in the upper tier tribunal. Right, but be wary of that. If you're noting things down from this webinar, there's a lot to note down. If you act for builders, you must warn them. Get them to have a look at the Gary Ives case. But this is a hot potato at the moment. Right, as I travel around the UK lecturing, people have come up to me and they've said, Tim, can we change the subject for a minute? What's happening with making tax digital for income tax? I'm thinking, this is a nightmare. Tom mentioned a nightmare at the start, the Tottenham defence. Quick word on that. It's all well, fantastic bombing forward, but you've got to have a back four, not a back two. That's all I'm going to say. I said that to my wife when we were in Rhodes on holiday, and she said, are you looking forward to the new football season? I said, well, I really enjoyed the Olympics. I enjoyed watching Keely Hodgson win her gold in the, was it 800 meters? Yeah, I've been following her for years, actually. She's fantastic. Disappointed Josh Kerr didn't get the gold. I think he was so obsessed with defeating Inga Britson that he didn't concentrate on the others. But I love the Olympics. I liked the tennis over the summer. So sometimes the football season comes too quickly and Spurs defence needs looking at. But anyway, where was I? Yeah, making tax digital for income tax. It's due to come in on the 6th of April 2026. And the big question, will it? Now, as Tom mentioned, there's a budget on the 30th of October. But will they make any further announcements on this on budget day? This is one area where they can make, and they have done in the past, the previous government, they can make announcements at any time. If you really push me, I don't think HMRC are ready and will be ready for it to come in on the 6th of April 2026. I mean, how long have they had to prepare? Wasn't this due to come in 2015? I don't know, but I've spoken to a software company at the start of this week, and we had an informal chat, and I trust these people, and they said from our dealings so far, they don't think HMRC are ready. it'll be fascinating to see if it does come in on time. Will there be a statement on this on budget day, 30th of October? Will it be delayed yet again? Or will it not happen? Will they make an announcement that it's not going to happen? It'll be fascinating to see. I would imagine by the 30th of October, you'll have heard something. I sincerely hope so. I would have thought so. Now, I lecture for all the leading tax lecture companies, institutes, everyone. And it was very interesting. One of the lecture company lecturers had a huge article a few weeks ago in Taxation magazine, an open letter to the Chancellor why he thought Making Tax Digital should be scrapped. If you haven't seen that, you should read that article. And I must admit, when I read the article by this lecturer who published it in Taxation magazine, an open letter to the Chancellor why MTD for income tax should be scrapped, I must admit a lot of the points he raised were very good, and I thought, I agree with you. So it'll be very interesting to see what happens. Now, what I've done is a Brucey bonus, a little bonus for you today. On pages 17, 18, and 19, I have summarized the very latest position on Making Tax Digital for income tax. And you just quite simply want to read through that. But can I just remind you, if it does come in on time, on 6th of April 2026, then huge extra work for accountants, and you will have to submit accounts for self-employed clients and landlords 1 month and 2 days from the end of the relevant quarter. But you've got to remember that these accounts will be cumulative. You want to write this in on page 17. And so the first set of accounts will be 6th of April to 5th of July, file 1 month and 2 days afterwards, 7th of August. And the next accounts will be for 6 months, cumulative, 6th of April to the 5th of October. This is on the bottom of page 17 of your notes. And then the third quarter will be 6th of April to the 5th of January, and the fourth quarter will be 6th of April to the 5th of April, 12 months. So it's cumulative, 3, 6, 9, 12. Do you know the danger of this, or the downfall of this? Every client will have to submit accounts for these quarters. So the accountant will have, and I've made this point on the next page, page 18, the accountant will have a bunched work areas each year, because they're never going to change. The filing date will never change. The one thing you could change slightly is you can make an election for the quarters to be calendar quarters rather than fiscal, but turn over the page to page 18. But the filing date will still be the same. So this is going to create an awful lot of extra work having to file the self-employed and landlord client accounts. And if they, for example, he's a plumber and he's got a rental activity, you will have to submit the trading accounts and the rental accounts, 2 sets of accounts, every quarter. If he's got 2 trades and a rental activity, you'll have to submit 3 sets of accounts every quarter. This is a lot of extra work with no flexibility, and it's going to be bunched work for accountants. So you might want to mark up the notes to keep an eye out in the next couple of months what the Labour government announce on Making Tax Digital. Read those 3 pages, and that summarises everything we know and how it stands at the moment. So you've got incredibly detailed notes today on the topics that I'm raising. And I know a few of you are going to go on holiday next week, so you might want to take these notes with you on the flight, and then your flight will go much quicker and you can study these notes in the air. Yesterday, I had a guy watching from New Zealand, which was just quite amazing, actually. So, yeah, but it'd be very interesting to see what happens to Making Tax Digital. And the other thing that you need to consider as well is, will the Labour government reinforce what Jeremy Hunt announced, in that he said, we're going to scrap P11Ds, and from 6th of April 2026, every employer in the UK will have to payroll benefits in kind. So this is another business tax huge change. So from 6th of April 2026, the plan is that they're going to scrap P11Ds, and every employer will have to put benefits in kind through the payroll and operate pay as you earn through the payroll. Now, this has all gone very quiet, but I must admit, I've spoken to a few people about this, and I'm hearing that the Labour government are fully behind this, just like they were with the scrapping of the furnished ID landlords tax reliefs. And I do think they'll endorse this change. I think what you'll see probably in the budget is a statement to say, yes, we're going ahead. And from 6th of April 2026, every employer in the UK will have to payroll each month the benefits in kind. It'll be very interesting to see what they finally announce with Class 1A national insurance. Will they announce that Class 1A is payable monthly as well? I think so. So watch out for that in the budget. And if you are an accountant and your clients have not payroll benefits, you need to start, when they announce that this is coming in for sure, you need to start preparing for that. You need to choose the software. I would start preparing for that a year in advance. I must admit, 3 or 4 years ago, probably more, probably 6 years ago, I really got behind it. In fact, I wrote an article, if you go to the archives, payrolling and benefits in kind. I think I wrote it about 10 years, 8 years ago now. But it's something I've been involved in heavily over the last few years, and I think it's a very good thing. I think the software is greatly improved, and I think many accountants and clients are currently payrolling benefits, so it'll come as no shock to them. But it's a lot who are not. So watch out for that in the budget, any statements. I think you'll get a statement reaffirming that. Now, for the last few minutes, can I go to the last page, page 21, and can I just consider other areas that you need to think about and to be aware about now and possibly prior to the October budget? You know, I could have done with longer today, but there's a limit to everything we can say and what you can do. But the one thing I would say, I haven't really had a chance to go on to basis periods yet, but you can do a Google search, you can get loads of articles on that. The one thing I would say, we'll be very careful with the transitional year with basis periods. It's not in the notes today, but if you Google articles on it, you can just download it, but you need to be very careful. And, you know, this extra profits that they're taxing, they're going to be spreading into the future. But you need to be careful, and you need to possibly consider an election to avoid the spreading, where you've got maybe in the next few years a client who hits the big time and suddenly is paying 45% tax. Well, you wouldn't want the spreading to be pushed into a year if they're a basic rate taxpayer at the moment. And I'll tell you what, it'd be very interesting if the Labour government increased taxes and you've spread your extra profits for the transitional year, automatically you push them into future years at higher tax. So the one thing I am going to say on basis periods, not in the notes today, but I'm just going to mention it for a couple of minutes. You need to be very careful with this automatic spreading, and there is an election that you can make to avoid the automatic spreading. But you've got plenty of time with that, and perhaps that's something for the future. Right, now in the last few minutes, go to page 21. We've covered a lot this morning, but go to page 21. Can I look at a few sundry areas for business tax that perhaps you need to think about? There has been rumours on the internet in the last few weeks that the Labour government are going to be a bit more strict with the taxation on benefits in kind for employees and directors. We're hearing quite strong rumours about that. For example, at the moment, if you've got a director and he's got, or a manager, employee, and he's got a company credit card, he can rack up air miles on that company credit card and they're completely tax-free. And we've seen a lot of employees use their air miles that they gain personally from having a company credit card to have a free holiday. Two things I've heard about benefits in kind. I think they're going to be tightened up a bit, but maybe the Labour government will also be a bit fairer, because you've got things like exemptions for relocation when your employer relocates and you move to keep up with your employer. You move down from Birmingham to London because the employers move from Birmingham to London. The exemption, the tax-free relocation exemption, is only £8,000. Now that was set in the 1980s, like most of these exemption figures. They need to be brought up to date with inflation. So hopefully there'll be a big revamp of benefits in kind. I think there will be, both tightening up and both increasing, hopefully, the exemptions that are due. Inheritance tax and business property relief. I do think there'll be changes there. I really do. I don't know if business property relief will be scrapped. I'm not sure, but I can see big changes to IHT in the forthcoming budget, and people are starting to plan for that now. R&D. My only comment on R&D today is that I think a lot of companies miss out on R&D claims because they don't think that R&D can be claimed on their expenditure. If you need any advice on R&D, contact us. We have an incredible R&D team at Gravita, and we can help you with that. But I do think, from speaking to accountants at my lectures, in early summer, I actually spoke to one and I said, what area has your client incurred this money in? And I said, I think there's a chance you would get R&D on that. And we gave the card and we're waiting to hear from them. They have come back. We're waiting to hear from them. So it'd be interesting to see. But if you need any help on R&D, contact us at Gravita. We've got an incredible team. And you'd be surprised, certain areas you think, oh, that's not R&D. You can get the relief on. We could help you with that. Right. Employee ownership trusts. I'm still a huge fan. I've written articles on that. And it's a fantastic tax planning opportunity where perhaps the owner of a big business, his children are not interested or he hasn't got children. And perhaps he wants to sell the business to the workforce. The workforce then form an employee ownership trust, and he sells to the business and avoids the tax. So incredible. We can help you with the planning on that. And as Tom mentioned at the start, I'm a huge fan of family investment companies. Family investment companies, it's a very effective tax planning tool. Keep an eye on what Gravita are doing on that. We are very involved in family investment companies, and we can help you in that regard. People have different views on fee protection insurance. I'm a big fan. I've been involved in it for over 20 years now, and I've seen the benefits of it. But as I say, people have different views. But remember, you can't claim the premium, and you have to add the premium back. Right, okay. I've raised a lot of things today in the last hour. You want to go and have a look at the notes in detail. Again, read them through, okay? If you've got any queries, you could contact, I think perhaps in the first instance, Tom. There's his email address there, and our team would be delighted to help you. Probably you've got some tax consultancy requirements as well, and on any of the areas that we've mentioned today, and we'd be delighted to assist you. And finally, can I remind you of the really interesting and topical webinars that Gravita are putting on? We help the tax profession, and that's our aim, and we'd be delighted to help you as well. And if you go to our website, you want to log in for and attend some of these webinars. Can I briefly tell you about them? Right, we've got a very good one on the 18th of September. Then we've got the landlords one on the 30th of October, very topical, and that will be a planning lecture, really, a webinar really, and it's going to really tell the accountants who've got landlord clients and furnished RD lettings owner clients what you should be doing. And then capital gains tax refresher, I think on the 28th of November, after the budget, that will be what can you do? What should you be doing? Capital gains tax now, I think it'll be completely different. I wonder if business asset disposal rate will be scrapped. I wonder if capital gains tax will be higher. Will there be an indexation brought back, inflation allowance? We will be looking at that in detail on the 28th of November. And the one that I think perhaps is the best of all, Dion, who I'm a great fan of, Dion Laycock, who deals with investigations, who's helped a lot of clients out over the years. He's doing a very, very interesting webinar on COP8, COP9, and alternative dispute resolution. You want to attend that, okay, because Dion can help you. If you've got any investigations now and that you need some assistance on, Dion's your man and he can help you, but he's going to be explaining all of those things on the 4th of December. Tax, to me, is fascinating. I must admit, I love it. I don't love certain aspects of it, but I do find it very interesting. And I'm going to reaffirm what I said at the start. A good accountant liaises with his client before they do the transaction and gives them advice on how to structure the deal and how to do it to maximize the tax reliefs. If you've got any doubts or any queries or you need any assistance at Gravita, we can help you because, you know, you don't cover every area. For example, I'm not particularly strong on VAT. I know all about it. I know when to look at it and know when to ask about it. But for sophisticated VAT planning, I ask our Gravita VAT lady to help me. And that's what you want to do as well. So contact us. And if you need any consultancy, come back to us as well. And watch out for our future Gravita webinars. Thank you for watching and enjoy the rest of your day. Bye-bye.